Hello everyone, this is Doc from the Wealth Boardroom. Welcome to the channel. The world of finance and investment can often seem intimidating, but it doesn't have to be. Our mission here is to demystify the stock market, break down complex concepts, and empower you with the knowledge to make informed decisions. Today, we are diving into the fascinating world of stocks, exploring different investment types, and learning how to evaluate a company's stock price. In this video, we'll explore how to build generational wealth investing in the stock market. To start, let's answer the question, what is a stock? Simply put, a stock is a share in the ownership of a company. It represents a claim on part of the company's assets and earnings. There are two main types of stock, common and preferred. Owning common stock gives you the right to vote at shareholder meetings and to receive dividends, which are a portion of the company's profits distributed to shareholders. Preferred stockholders, on the other hand, generally don't have voting rights, but they have a higher claim on assets and earnings. This means they get dividends before common shareholders and have a higher claim in case the company goes bankrupt. Stocks can be bought and sold on various stock exchanges, such as the New York Stock Exchange or NASDAQ, through brokers or direct investment plans. So when you buy a stock, you're buying a piece of a company. Now, you might be wondering how the stock market works. Well, the stock market is a marketplace where buyers and sellers trade shares of publicly listed companies. Think of it as a grand auction house where the highest bid gets the share. The price of these shares fluctuates based on supply and demand. If more people want to buy a stock than sell it, the price goes up, and vice versa. Now, on to the big players, the S&P 500, NASDAQ, and Dow. The S&P 500 is a benchmark index of the 500 largest U.S. publicly traded companies. The NASDAQ, on the other hand, primarily lists technology companies. Lastly, the Dow, or the Dow Jones Industrial Average, represents 30 significant stocks traded on the New York Stock Exchange and the NASDAQ. These three major indices provide a snapshot of the market's overall health. There are different types of stock investments to choose from. So let's break this down. First up, we have common stocks. These are the most prevalent type of stock that people invest in. When you buy common stocks, you're essentially buying a part of the company. You get to vote at shareholders' meetings and receive dividends. But remember, if a company goes bankrupt, common shareholders are the last to receive any remaining assets. Then there are preferred stocks. Preferred stockholders have a higher claim on the assets and earnings of a company. They receive dividends before common stockholders and have a fixed dividend rate. However, they don't have voting rights like common shareholders. There are also different sectors you can invest in, like technology, healthcare, or energy, each with its own set of dynamics and risks. Remember, investing in stocks is not a one-size-fits-all strategy. Choosing the right type of stock investment depends on your financial goals and risk tolerance. Before investing, it's crucial to evaluate a company and its stock price. The first step in evaluating a company is to examine its financial health. Look at its balance sheet, income statement, and cash flow statement. A healthy company will have a strong balance sheet with more assets than liabilities. It will also have a positive net income and strong cash flows. A company's financial health can also be assessed by looking at key financial ratios. One of the most commonly used ratios is the price-to-earnings ratio, or PE ratio. The PE ratio is a valuation ratio, calculated by dividing the market value per share by the earnings per share. This ratio gives us an idea of what the market is willing to pay for a company's earnings. The PE ratio can be a useful tool for comparing the relative value of different companies. A high PE ratio could mean that a company's stock is overpriced, or it could mean that the market expects high growth rates in the future. Conversely, a low PE ratio could indicate that the stock is a bargain, or it could suggest that the market has low expectations for the company's future growth. However, the PE ratio isn't the only thing to consider. It's important to look at a company's overall financial picture, including its growth prospects, competitive position, and management quality. Remember, a company's stock price doesn't necessarily reflect its value. Investing in the stock market also comes with tax advantages. One of the key benefits is the long-term capital gains tax. When you hold onto a stock for more than a year, any profit you make from selling it is considered a long-term capital gain. This is taxed at a lower rate than ordinary income, which can be a significant advantage for investors. Additionally, certain types of accounts, like individual retirement accounts or IRAs, offer tax-free or tax-deferred growth on your investments. This means you won't have to pay taxes on dividends and capital gains as long as the money stays in the account. Then there are tax-efficient funds, which aim to minimize the tax burden for investors through strategies like holding stocks for longer periods and avoiding high dividend stocks. Remember, these tax advantages can significantly boost your investment returns over time. Understanding and taking advantage of these benefits can help you keep more of your hard-earned investment returns in your pocket. So how can you build generational wealth investing in the stock market? Well, the concept of generational wealth is about creating and growing assets that can be passed on to future generations. The stock market, with its potential for high returns over the long term, is a powerful tool for achieving this. The first step is consistent investing. This means regularly buying stocks, regardless of the market conditions. It's not about timing the market, but time in the market that matters. When you invest consistently over time, you benefit from the power of compound interest, which Albert Einstein famously called the eighth wonder of the world. Next, let's talk about reinvesting dividends. Many companies distribute a portion of their profits as dividends to shareholders. Instead of taking these dividends as cash, you can choose to reinvest them by buying more shares. This way, your wealth grows exponentially over time, as your dividends earn dividends of their own. And of course, holding investments long term is key. The stock market can be volatile in the short term, but over the long term, it tends to rise. This is where we can learn from successful investors like Warren Buffett, Peter Lynch, and Carl Icahn. They didn't make their fortunes overnight, but by investing in quality companies and holding on to those investments for years, even decades. Warren Buffett, one of the most successful investors of all time, advocates for a buy and hold strategy. He once said, "Our favorite holding period is forever." Peter Lynch, another legendary investor, echoes this sentiment, saying, "The real key to making money in stocks is not to get scared out of them." Building generational wealth isn't a get-rich-quick scheme. It requires patience, discipline, and a long-term perspective. But with these strategies, consistent investing, reinvesting dividends, and holding investments long-term, you're well on your way to creating a legacy of wealth that can benefit your family for generations to come. Building generational wealth requires patience, discipline, and a long-term perspective. And that wraps up our discussion on building generational wealth through stock investing. We've covered a lot of ground today, starting with the basics of understanding what a stock is, all the way to the practical steps of evaluating a company and its stock price. We've explored the workings of the stock market, differentiating the S&P 500, NASDAQ, and the Dow. We've also delved into the various types of stock investments and the pros and cons of each. Moreover, we've highlighted the tax advantages that come with investing in the stock market, a factor that should not be overlooked when considering your investment strategy. Most importantly, we've discussed how these elements come together to help you build generational wealth, following in the footsteps of great investors like Warren Buffett, Peter Lynch, and Carl Icahn. Thanks for tuning in. Don't forget to subscribe to the Wealth Boardroom for more financial wisdom. Until next time.